All right. Before we go into our materials and I just set up what we'll do today, I wanted to just share with you, in case this is of interest to you, you may know that the school has this series called Money Boss, which is about personal finance and entrepreneurship. And they have a site, it's guides.laguardia.edu/moneyboss, where there's all kinds of information about personal finance and other, interesting bits of information, whether it be about entrepreneurship, identity theft, and so on. They also run workshops. The bulk of the workshops are offered, they're offered through the library, but they're actually done by business and technology faculty. And there is such a workshop happening tomorrow, from deficit to surplus, how to turn that debt around. So this is talking about, I guess, getting rid of debt, trying to pay down debt, and so on. I just thought I'd share this. Maybe you're not necessarily in debt or you don't have debt, but attending some of these Money Boss workshops can be really helpful to begin to, or to continue to keep your finances in order. If you go to this guides.laguardia.edu/moneyboss, or if you just simply type Money Boss into the search bar on the LaGuardia website, it will come up and you can register, and then it's a virtual event that you can attend. And then I've already mentioned this to you before, but I'll just mention it again, that or maybe I haven't mentioned it to this class, I can't remember, sorry, I have 3 different classes, so forgive me if I haven't mentioned this, but you guys have probably been around the longer than my other classes, so you may know this, that by virtue of being a LaGuardia student, you get a free subscription to the New York Times and the Wall Street Journal, but you just have to sign up with your live .edu email address, so they can see that you are a student. And then just like I said, over here there's actually recordings of the past workshops that they had for Money Boss. So fiscal responsibility, e-commerce, there's starting a business in challenging times, investing. I attended this workshop. It was by Professor Trapani, very interesting. So if you don't have time to go tomorrow, that's fine. They'll record the workshop and post it on the site. And if you are ever so moved to watch some of these presentations, it's good information around personal finance. So that's the first thing that I want to say. And then the second thing is that on and I may have mentioned this again, that there are still devices available at LaGuardia for borrowing. So if you need a laptop, or if you need, I think they have Dell 3100 series. If you need an iPad, I think it's iPad Series 7. Or if you need a Wi-Fi hotspot to try to enhance your Wi-Fi at home or wherever, you can go into My LaGuardia and do a loan of a device. And remember, there's pickup from the school and so on. So if you need any type of device, just, go on My LaGuardia and you'll find the info, or find the place there where you can get it. And then the last thing, I know, we're so tired of seeing this this calendar already, but to me, it's very important to make sure that you are staying on top of your dates. We know that the date passed for the homework on Monday at 6 o'clock. My plan for today is that we'll finish up chapter 9, and then I'll actually go over the homework for chapter 8 to just make sure that, everything is in order. People don't have any lingering questions or concerns about that, because remember, chapter 8 and 9 are part of the first test. So I just want to make sure. I did look at the results. A lot of people got 10 out of 10 or close to 10 out of 10, but there were some tricky bits. So I just want to make sure that you actually, for those who had some difficulties, that those are resolved by speaking through it. And for those who maybe did get 10 out of 10, but aren't sure exactly why an answer was correct, that you have a chance to ask me that. So that's done. Today we'll continue with with chapter 9. We'll finish it most likely. And then I already received one draft of a term paper from someone in this class. The rest of you have until Sunday at 6 o'clock if you want to send a draft. Remember to manage the page limit. The whole paper is only supposed to be 4 to 6 pages, and it's only 2 parts, so it's really 2.5 to 3 pages double space that you're writing. So it's not, a ton of writing. And you already know this, but we have our Reg Hour class after this class. So the Zoom meeting info, in case for some reason you suddenly forget how to get into that class, is over here on Blackboard. All right, because today's Wednesday, so you have your class with Raphael again. Okay, so yes, next week it does still say chapter 9 for Wednesday. We'll probably be, fairly close to done with the chapter, if not completely done, but you guys may have questions because you may have taken this day to already start on the homework. So, you can always ask me over email or maybe before the class starts or whatever, some questions on chapter 9. And if there's not that much to deal with, we can start out on chapter 10. Today, I did, have the chapter 10 stuff up here. I don't know how far we'll get. I'm not trying to push us too hard, but everything to do with chapter 10 is already available. It's been available on the site, so you can see what's coming. Chapter 10 is about asset acquisition. It's really about property, plant, and equipment, and how we record the purchase of that, or if we're constructing something, there's some extra thinking around that. So chapter 8 was about our inventory asset. So was 9. Chapter 10 is about the fixed assets or property, plant, and equipment. All right, and then the last thing, and again, yeah, I'm becoming a stuck record, but I don't want people to be dropped from their classes. Tomorrow is the absolute last deadline for people to upload their vaccination records. All right. Does anybody have questions about anything that I just discussed? I see people are falling off the call. I guess people are having problems with their internet. Remember, if you are having problems with your internet, that Wi-Fi hotspot that I was talking about, the school is trying to give out to students to, I guess, help with connectivity. I'm not sure of the exact ins and outs of it, but you can probably see it if you go onto My LaGuardia and look for device loans. Anybody have questions about either the work or the deadlines or anything? No? Okay. So I guess, it probably is important for me to say that next week, I didn't, let me see if I can open. Next week, Friday, the 15th of October, is going to be the first day when registration opens for the spring. If you are not graduating the semester and you still need to take classes for the spring, you will probably be fairly early in the registration cycle because they usually have students who are higher in terms of the number of credits that they have to start registering first. Please be sure to think about which classes you want to take and register as soon as possible. Remember, you don't have to pay as soon as you register. You will pay later. There comes a date by which you have to pay, and after that date is when you could potentially be dropped from the class if you didn't pay. So you don't have to pay at registration time. You just have to register for classes. It helps us as faculty, it helps the school to see how many classes have to be made available to the students. if people register early, because if people wait till the last moment, what ends up happening is that classes get cancelled, and then students need classes, but there aren't enough classes for the people who do need them. So again, if you are intending to graduate, make sure that you have that, the graduation that you registered for the GRD with the 3 or 4 zeros after it. And also, if you're graduating at the end of the spring semester, you also need to register for, that's this, I'll write it in the chat. I think you guys already know what I'm talking about. And it comes up in, in the class with Raphael, where you guys eventually, you're not there yet because you were talking about me, but as you work through your e-portfolio, you'll have to be thinking about transfer, you'll have to be thinking about, career and so on. And when you are thinking about your final semester, and if you've registered for everything, this GRD 4 zeros class, it's not an actual class, but it shows intent to graduate. You have to do that at the start of the 12-week semester, when you are planning to graduate, so that the registrar will know that you intend to graduate, and will be able to actually check your degree works to make sure that you've done all the courses that you're supposed to. All right. So next week, Friday, is the big day to start registering for classes. And if you want online classes, you've got to move quickly, because a lot of those classes are going to be much fewer in the spring because of the CUNY mandate that only 30% of classes can be online. Anybody have questions about registration?
Can you repeat the intent to graduate class?
Yeah, actually show you, because I'm feeling now a little bit insecure about whether it's 3 or 4 zeros behind it. So I'm just going to show you on the degree map, okay? What the class is, just bear with me. You also see this when I ask you some questions in the e-portfolio. Yeah, it's 3 zeros, my apologies. GRD 000, intend to graduate in CUNY first. You have to actually include that with the rest of your classes that you register for, because it's basically like you're applying for graduation in your final semester. So if you're going to finish in June of this year, and you're registering for the spring starting October 15th, this GRD 000 intend to graduate class has to form part of your course selection for the spring. Please note that it's not an actual class, it's just an alert basically that you're giving to the registrar to show that they need to audit your transcript to make sure that you can in fact register. Can in fact graduate. Because the last thing you want is to think that you're graduating and then be told by the registrar that something is up with your transcript. Right, so that's what they're trying to avoid. You tell them at the beginning of the semester that you have an intent to graduate. They go through everything and basically confirm that you can graduate at the end of the semester. And that has to be done at the start of the 12-week semester that you intend to be your last semester at the college.
Okay, got it. Thank you, Professor.
Right. Okay, right, so if there's any other issues with if you have a class that you can't get, or you had a prerequisite, especially if this is business courses, there's some prerequisite issue, or there's a BTI 201 issue, whatever, guys, please feel free to email me. I am in contact with a lot of the admin people from the department. I can always try to help you to resolve anything so that you guys can be registered, and so that you can, finish successfully and be on your way to which the next stop in your academic journey. All right, so that's the deal with all the admin. If there are other questions, people are free to put them in the chat, and I'll try to handle them. We're moving here to, like I said, we're in the closing phases of chapter 9, and so there's really about three things that we still need to talk about, and so I'll show you here The three things are what happens if a company changes its inventory method. So by method, I mean it goes from, you know, FIFO to LIFO, LIFO to FIFO, from either of those to average cost or back again. You know, what does the company have to do? Is this a change that happens from today forward, or do we have to look back and say, what would the numbers have been if we had made this change, you know, from like the beginning of, let's say, the first set of numbers that are shown in the financial statements for that year. So there's change in inventory method. We also have to talk a little bit about inventory errors. I had mentioned as we went along, because of that relationship between inventory and cost of goods sold, if there is an error in inventory, whether it's beginning or ending inventory that has an error in it, or both, I mean, it is possible. There's actually a lot of implications in, you know, if it's a material error, which means the mistake is big enough that you have to go in and correct your numbers. It will impact the balance sheet, and it will impact the income statement, especially if it's, you know, ending inventory being shown on the balance sheet. It's going to be an adjustment for the balance sheet and the income statement. If it's beginning inventory, that's the error. Obviously, beginning inventory is not what's shown on the balance sheet, but there's a problem in cost of goods sold. And then you also have to think that beginning inventory of this year was ending inventory last year. So is your prior year's financials also, you know, a problem? So we'll go through, you know, at length to make sure that everybody understands what the impact would be on just about everything, right? On inventory, on cost of goods sold, on net income, and on retained earnings, if there are under or overstatements of beginning and ending inventory. So that's the second piece. And then the last piece is how they usually do these chapters, if, you know, if it's applicable. We didn't really have this for chapter 8 because there wasn't, I mean, there was a presentation in the sense that, you know, inventory shows up on the balance sheet, but in chapter 9, we're kind of looking at presentation and analysis for kind of both chapters together, talking about where does inventory show up, you know, on the financial statements, and also what formulas, what you know, ratios. You may remember this from accounting 2, or not, that's fine. Inventory turnover ratio, average days to sell inventory, or just days in inventory. What do we use to calculate, you know, these numbers, and how do we interpret them? All right, so that's what we've got left over. It's not a ton of stuff. We'll go through it, make sure that we're comfortable with it. And then after that, I'll just review a little bit the homework from chapter 8 to make sure that people are solid on that. And then we'll see where we are time-wise, if we still want to push further. All right, so if you you know, if you look at the textbook, you see here that they do have, I mean, my notes are basically following the textbook. They do have a whole piece on you know, inventory changes, you know, again, changes from one method, and method we mean cost flow assumption, to another. And I'll just go over the, I guess, the notes that give the brief overview, then I'll jump back into the textbook just to look at the example they have there, which is pretty decent. So we might as well just look at that. So changes in inventory methods, which is also, it could also be thought of as a change in accounting principle, moving from one cost flow assumption to another, other than a change to LIFO. So, you know, that's important. So just, and remember, it's a change to LIFO. A change from LIFO to something else is fine, but it's a change to LIFO, or reported retrospectively. Does someone want to tell us what this word means? Can I get a hand, or someone just shouting out, what is what does it mean for something to be retrospective?
Looking back.
Yeah, you go back, right? So this is a big job. If you're working at a company and they say we want to change our inventory method for from let's say from LIFO to FIFO, if in your balance sheet you're showing maybe 2 comparative years and maybe a third year of numbers that are discussed, you will probably have to go back 3 or 4 or more years, and all the numbers that were on LIFO, all the inventory numbers now have to be changed as if the cost flow assumption had always been FIFO. So just think about the enormous, right? We've done LIFO, FIFO, average cost calculations here, with questions out of the textbook, but in reality, it's an enormous amount of work, because you're going to have to look at the internal records that the company is keeping and how you can use those, right, to be able to help you to over 3 or 4 more years to change the numbers to now show the new method. Why does anybody want to throw out why you think a company may do something like this? Why would they change the inventory method, given that it's actually a lot of work?
What the question, Professor? Can you tell me again?
Yeah, sure.
Yeah, sure, the question.
Sorry, I can hear myself. The question was, why do you think a company may want to change from one inventory method to another, given that it's quite a lot of work to do that? Not necessarily an easy question, so it's okay if you guys want to think a little bit. Why would I change from one method to another, especially considering the amount of work that it will take?
If the company don't profit this inventory, they should be changed for another.
If the company doesn't what?
If doesn't company great much more profit those
Oh,
inventory, they should change.
okay, so you're saying, wait, I need to mute you because I feel like, okay, because I feel like I'm hearing myself talk, which is never pleasant, right? Yeah, you're saying maybe if they're trying to look for more profits. I don't know that you can change just for the sake of profits. It has to be something a little bit more beneficial to the user. Go ahead, Antora, you want to take a stab at this?
Yeah, is that to avoid paying taxes?
I mean, that's the LIFO approach does result in less taxes. So I guess you're on the same wavelength with Sharon, where you could keep some more money in your pocket. Yeah, but do you think you can write in your and Tora, do you think that the company can put in its footnotes of the financials that we changed to LIFO because we're trying to avoid taxes?
No, not like that.
So they'll have to. So the reason may be that they're trying to avoid taxes, but they'll have to give and yeah, I'll help you guys out. They'll have to give an answer that maybe has something to do with matching revenues with expenses. So for instance, LIFO, because it assumes that the the latest inventory that is purchased is the first to be sold. It more appropriately matches current inventory costs to revenue, right? Because those numbers are very they're current, they're more timely. So a company may, on the side feel like they want to pay less taxes, but when they're writing up the footnote, and I'll show you here in the book, they even have a footnote, well, actually, this is just the scenario. I'd have to go back and find a footnote for you. But in the footnote, they would say something like, on January 1, 2021, Antora Inc. changed its inventory, method from FIFO to LIFO. This was done to more readily match current revenue to current expenses. And then that would be, and then they have to go into the amount by which, the inventory, so ending, because it's LIFO now, the ending inventory number is obviously going to be lower because it's the old inventory. And so they'll have to say, as a result, inventory changed by this much. And the other side of that journal, because remember, when you're making these changes, you eventually have to make an adjusting journal entry. The other side of that journal entry will be to retained earnings, because the other side is really cost of goods sold, right? You're changing inventory, you're changing cost of goods sold, but cost of goods sold is a temporary account that is closed off every year to income summary. So, and then to retained earnings. So when we make the adjustment for the change, it's going to end up in retained earnings. So you guys are, you're Jaron and Antora, you're right in the sense that companies are always thinking about profits, and maybe tax and saving money. But when we give the formal reason for why they make the change, it has to be something that is more appropriately worded to supposedly benefit the users of the financials, or to show numbers that are more accurate is not the right word, but just numbers that I guess are more relevant to users. Someone's asking, is it poorer? Is it to get rid of the inventory, especially the old ones, because they expire? Well, yeah, you have to remember, poorer, that the cost flow assumption is not the same as the physical flow of inventory. In the physical flow of inventory, meaning how the inventory was sold, the old inventory is actually already sold long ago. We are just assuming that it's not sold. All right. So we wouldn't put in our explanation that, we did this so that we can sell old inventory, because the old inventory is actually sold. The gap just allows you to assume that it's not sold as part of your book calculations. But the reality, like if you go into a supermarket or you go into a Walgreens or CVS, the reality is that the old inventory was sold already. All right. So what you would say, Cora, is what I was saying to Antora, is that the company would say more like they're trying to go to, let's say, to LIFO, because they want the cost of goods sold to be closer to current prices. That could tie in with what you're talking about. If we move from LIFO to FIFO, the reason there normally is that they want ending inventory to be more close to real life prices. Okay, it's kind of just the same thing in the opposite direction. They're using the current prices of things almost like as the basis for why they would want to make this change. And everything happens retrospectively, which means it is, and it's going to be a significant amount of work for the company to get the numbers right. But the only thing that does not happen retrospectively is if you change from average cost or FIFO to LIFO, you're not required to go back and adjust your numbers. You just adjust from this year forward. And part of the reason for that, and I think it's mentioned in your book here, that the change to LIFO is not retrospective. And part of that is just because it's almost impossible to get those old inventory numbers. They don't expect, because with LIFO, you're assuming that the earliest inventory from like when the company started almost, or whatever, if they didn't liquidate any LIFO layers, that's the inventory that is still there, to this day. So imagine if the company started like 20 years ago. I mean, who's going to know what the inventory balance was at that point? Like, it's almost impossible to know that. So, so you can see there that, and the book explains this, that there's an exception for LIFO, because we would not be able to, find the inventory numbers from the beginning of time. So remember that a lot of the changes in accounting principles or methods, we'll come up with this again When we do depreciation, there's, depreciation changes as well in Chapter 11. Many of the changes are retrospective, but some of them, especially when the numbers that you're changing or the method that you're changing is a type of an estimate, is what we call prospective. Like LIFO is prospective because we can't find the old numbers, so we can go from today forward. But many times if you go back to change from one thing to another, it's retrospective. So here's the journal entry for the change, debit or credit inventory and retained earnings. The reason why it's saying debit or credit is it depends which method you're changing to. Sometimes the change will result in the inventory number being higher, and sometimes it will result in the ending inventory number being lower. And then this is what I was talking about. You have to provide an explanation in the footnotes of the financial statements as to why the new method is preferable, and it can't be, because I don't want to pay tax or I want to make more money. You have to give something that sounds a little bit more like it's theoretically sound, and it also helps the users to understand the financial statements a little bit better. And then there will likely also be some information on the impact on net income and earnings per share and so on. And like I said, the change in LIFO is the current period and subsequent periods. That's how you make that change. So I just wanted to use the textbook example. Yeah, I didn't duplicate the example in our notes, so you can refer back to the textbook when you want to see how this plays out. It's not a huge topic, so don't panic that we're not doing like 10 examples. We don't have to. So here's an example of a change in inventory method. Auto Geek Inc., a wholesale distributor of auto parts, began business in 2018. Inventory reported in the 2020 year-end balance sheet determined using the average cost method, so that's the method that they were using, was 123,000. So the ending inventory balance, 123,000. In 2021, the company decided to change its inventory method to FIFO. So they went from average cost to FIFO, which means they have to do a retrospective change. If the company had used the FIFO method in 2020, so you see how, because you're doing a retrospective change, you have to look back at previous years and pretend, right, that you were always using the new method, and you have to come up with what the number for inventory would have been on the new method. So if the company had used the FIFO method in 2020, ending inventory would have been 146,000. So 146,000 is higher than 123,000. And this change in the number also makes sense if prices are going up. It might be a little bit hard to remember, but I'll refresh your memory. When we were doing the calculation of ending inventory and cost of goods sold under FIFO, LIFO, and average cost, whether for periodic or perpetual, it doesn't matter. Ending inventory under FIFO, because FIFO ending inventory always has the latest units, which have the higher prices. That ending inventory was always higher than LIFO or average cost. Remember, average cost always ended up in the middle between FIFO and LIFO. So FIFO assumes that the first thing to be bought is the first thing to be sold. So all the older inventory has already been sold, and the newer, more expensive inventory is left over. So it makes sense that the FIFO ending inventory balance is higher than average cost. What steps should they take to report this change? Like I said, they will change all their, what we mean by comparative financial statements is, if you're looking at a balance sheet, they normally show at least 2 years of numbers. So they have to revise all those numbers as if they were always using FIFO. Okay, and then they also have to make a journal entry to record this change. If you look at the math here, obviously the inventory number has to go up by 23,000, right? 146,000 minus 123. So with that being said, remember we said that the journal entry is either debit or credit inventory and debit or credit retained earnings. In this case, we're not going to go into what's the tax impact of the change and so on, because remember, we're actually increasing profits at this moment, so there might also be tax implications. So the inventory numbers going up by 23,000. So you debit inventory, and then retained earnings is picking up the 23,000 increase. Again, you can't credit cost of goods sold, which is actually the number that would have gone down, if we were actually doing FIFO. The cost of goods sold under FIFO is lower, but you can't go back to cost of goods sold, because those cost of goods sold accounts were already closed to retained earnings in the previous year. So you just adjust retained earnings and increase it by 23,000. So we see the relationship here, right? When ending inventory goes up, that means cost of goods sold goes down, which means that the net income went up, and net income going up causes retained earnings to go up as well. And then you end up showing in your notes the change that happened, the whatever disclosure you need to make in your notes. So that's the journal entry. They do give a whole long spiel here on CVS changing the I think it's they have some split between the front store inventory and I don't know if it's the back or what, but they made an inventory change. I'm not going to read through all of this because there's some terminology that we really don't have to be bothered with. What I do think is important to look at over here is right at the end, the company recorded the cumulative, sorry, I keep forgetting that this thing wants me to mark up if I highlight it. The company recorded the cumulative effect of these changes in accounting principle as of January the 1st. So it means that, they decided to change their method effective January 1st. They went back retrospective, right? And looked at everything that needed to be looked at, and came back with a number as the total impact of that change. And then they said the cumulative effect of all of that, it was to decrease inventory by 7 million. Let me just highlight it since this thing is forcing me to. This decreasing inventory of 7 million. And yeah, don't worry about the deferred taxes. You'll get to deferred taxes at your 4-year school, but also decreasing retained earnings by 4 million. So inventory was credited and retained earnings was debited in their change of inventory method. All right, so that's really it. How would this get asked in a question? If you guys are worried, how does this look in a test or something? It's really got more to do with knowing that the change is retrospective unless it's LIFO, right? There's a retrospective change, so that kind of sounds like a multiple choice question to me. And then maybe the journal entry. I mean, I haven't set the full test yet for chapter 8 and 9. So the likelihood is that something small about how to do the journal entry. And how do you do that? You're looking at the difference between what the inventory was on the old method and what it is on the new method. And then you are making a journal entry, either debit or credit inventory and retained earnings. But I won't be asking you to write up some long thing or anything like that. That's not part of our, that's outside of the scope of our work. And as I said before, when there's a change to LIFO, it has to be done for the current year and subsequent years, because it's not possible to figure out, the beginning inventory in the year that you started accounting for stuff using LIFO. It's just too long ago. One more piece to say here. Let's see how this company discussed which method, right, that they changed their method and how they phrased that, to not say we wanted more profit. The company decided to change its inventory valuation method from FIFO to LIFO, right? In the high inflation environment that the company is experiencing, the company believes that the LIFO inventory method is preferable over the FIFO method because it better compares the cost of current production to current revenue. So that's what I was saying earlier when I said often companies will say that LIFO because it's the last thing to be bought is the first to be sold, it basically matches revenue that you're earning right now to the costs that you're actually incurring right now and not to old costs from long ago. Selling prices are established to reflect current market activity, which recognizes the increase in costs. So they want their production, they want their inventory to also recognize those costs. Under FIFO, those costs were not aligned. All right. So the onus is on the companies to really make sure that they know why they're doing this, because you can't just switch between methods. I think if I'm remembering my reading correctly, I think the company is not able to make another change for 5 years after they've made a change from one method to another. They have to stick to that method for 5 years before they can make a change. So it's a pretty big decision. And yeah, they also, the Seneca Foods also addresses the fact that retrospective application for LIFO for periods to the current year was impracticable, which means it was not possible for them to do it because period-specific information necessary to analyze inventories, including inventories acquired as part of the prior fiscal year's signature. This is obviously a company that they bought, were not readily available and could not be precisely determined. So GAAP already allows you to do a LIFO change to LIFO from the current and future periods, but they're also just telling their users that they were not able to look at, to come up with the numbers because they just don't have the numbers, which is fine, right? And so this is what I was saying, you have to justify your change. You have to remember that if you change to LIFO for account, if you have LIFO for tax, you have to have LIFO for accounting as well. The IRS specifically requires that so that people don't just try to use LIFO for their taxes to try and avoid tax. And then, when a company changes from LIFO for tax purposes, it can't change back. This is what I was reading, can't change back to LIFO for 5 tax returns. So you have to think of the interplay between what are you doing for tax, what are you doing for accounting. You can't hop back and forth between methods, and you have to be very careful, right, about how you account for a change in inventory method as well. Right, so this piece of the textbook here is pretty well set out to work through the concepts around changing inventory methods, and this is really the extent of what you need to know. So I'm not going to do any more examples. You can use this example and it should be fine. Does anybody have questions about this change in inventory method before we go to inventory errors? Crickets? Okay, nothing. All right. So, I'll talk about inventory errors here, and we can maybe just see if the book has anything exciting about companies maybe having inventory errors that they've had to fix. But again, these topics, you saw that the inventory method topic was literally like a page, right, in the textbook, sorry. And then inventory errors, similarly, it's not I mean, it's, when it's discovered 1 year later or 2 years later, but it's like a page and a half. So just be aware that these are not huge topics. If you're thinking about this chapter, you're thinking more, big topics are more like low of cost, net realizable value, low of cost to market, gross profit method, retail inventory method, and then you have these other topics where you will need to know what to do, but they're not the sole focus of the chapter. So inventory errors, if an inventory error is discovered in the same period it occurred, I don't know why I was so redundant here, the erroneous error, right? That's really saying the same thing. So trying to see if I can. The error should be reversed and the correct one recorded. So it's a big relief if you find the error while you're still busy with that same year's stuff. The thing that you don't want is for the error to be found after you've already issued the financial statements, right? So some of you are going to go work at, some audit firm maybe, and you're going to audit client financials, or you will be the client and you'll be preparing the financials. Let's say it's December 31 year end, and you're being audited or you are auditing. It's usually a 3-month ordeal, right? To audit the entire, financials of the company. I've done this many times. They were, back in the day, right, long ago, but it's still very vivid in my memory, because 3 months sounds like a long time, but it becomes so short when you're trying to do an audit for a company. And the purpose of an audit is not to find errors or fraud. I know that sounds crazy, because you would think, well, it's an audit. Isn't that the whole point, that you want to see if everything is correct? You're not trying to see if everything is correct. And this goes to that first, no, not the first, but the first part of your term research paper, where I ask you what's the purpose of an audit and who's auditing the company. Finding fraud and finding errors is not the purpose of an audit. The purpose of an audit is to determine whether the financial statements are fairly represented or fairly presented, right? Materially based on what the company is saying, right? The balance sheet, income statement, and so on. You see that line in the audit opinion, that they represent everything that the company is supposedly saying, but we're actually using samples to determine that, because it's impossible for us as auditors. If you think of sales revenue, for instance, if I'm auditing Whole Foods, there's no way that I'm going to look at every transaction to make sure that it's correct. What I'm going to do is I'm going to get a sales revenue balance of 5 billion, and I'm going to say, based on this 5 billion balance, how many transactions or how many things do I need to look at in order to satisfy myself that 5 billion fairly represents the revenue of the company. And so I'm not going in there with my magnifying glass trying to find fraud. Has there been fraud found on audits that I was on? Absolutely. Have there been errors found? Absolutely, right? It comes out often as part of the testing, but you are not there specifically to find the fraud. Now, if you are a forensic accountant, which some of you may decide to do, there's seemingly a pretty good forensic accounting program at John Jay. You would go in when there's already a notion that something's wrong, and go in and do, you're actually looking for fraud at that point. But regular accounting and auditing is just a sample-based testing of numbers to make sure that they fairly present what the company is saying. So an inventory error could be found by the company. It could be found as part of the audit. In fact, you saw it on your Chapter 8 homework example 1, right? Where you were asked what is the correct inventory number supposed to be. So because there's a difference, there's a difference between what the company has recorded and what they should have recorded. That's an error. And the hope for companies is that they find the error in the period that it happens, because then they can just make the changes and we're done. But if a material error, and again, materiality is dependent on the company, right? If you are, Whole Foods, a material error is not going to be, $1,000 error in inventory. It's probably going to be, 600,000 or something like that, because of the incredibly huge numbers that they're dealing with. I'm just guessing. Whereas if you're auditing, the bodega on the corner or something, $1,000 error in inventory may be material to them. Okay, so when you see this word material in the textbook, or you hear me saying it, materiality is dependent on the actual client that you are working with. It's not a number that exists in the world that you can base all your decisions on. And a material error also means that that a user of the financial statements would have been impacted in their decision making if that error had not occurred. So I usually think of things like an investor or a bank, you know, if they're saying like, if that error hadn't happened, the person may have thought differently about whether they would give money to the company. That's an easy way of thinking about materiality. So if a material inventory error is discovered in an accounting period subsequent, so after the period in which the error was made, any incorrect prior year financial statements should be, there's that word again, retrospectively restated to reflect the correction. All right. So big disaster. If you are a publicly traded company and you already went through your audit and your financial statements were issued and you find out afterwards that there's a material error in inventory, you literally have to issue a statement to say that an error was found. Then I think it's Form 8K. I have to check, right? Because I don't want to give you wrong information, but I'll look it during the break. But you have to literally issue a statement to say that there was an error. You have to go and fix the error. Then the auditors have to come back and audit to make sure that the error was actually dealt with appropriately. And then you have to reissue your revised financial statements. So it's not only a time-consuming process, it also becomes an expensive process because you have to, the auditors have to be paid again basically to come up with another, I guess, audit opinion as to whether things are now okay. So then you could say, well, can't you blame the auditors because they were there, they should have found it? Remember, I told you before that the auditors, their purpose is not to find errors and fraud. They're doing, their sample testing. Maybe there'll be a fight between the client and the auditors to say you should have found this inventory error, but it really depends on the facts and circumstances of the case. All right. So that's the background of inventory errors. We have an example to do that will help us to remember the impact of the errors. Very simple example, but hopefully help to remember the impact of the errors. Before we go into that though, I think it's important to note that, yeah. Okay, so this is already said, right? For material errors, this is kind of like the summary of what's being said here. So I'm just going to jump here. So for material errors, the previous year's financial statements are retrospectively restated and incorrect balances are corrected. And you may also have to fix retained earnings and you have to do a disclosure note and so on for an inventory error. And then here, again, if the error is discovered, the next year, not in the current year, the next year you're going to fix, right, the previous year's financials. You're going to do some type of journal entry, and it will always be a mix between retained earnings and inventory. And, it's either debiting or crediting one or the other. And it's a prior period adjustment to retained earnings, which is basically, what I was saying before, you have to go back and fix the prior years. But I want to actually just speak here quickly because it's not so obvious in my notes, but I think it bears mentioning. Because of the relationship between beginning and ending inventory and cost of goods sold, if you only find the error 2 years later, okay, not 1 year, this was after 1 year, right? Okay, so let me actually just backtrack. This is if you find the error in the current year, then you just fix everything, fix your notes, everything, make sure that you got everything fixed, right? And you should be okay. If you find it the following year, then you're going to go back and fix the prior year, which is a pain, but you're going to have to make the prior year adjustments and so on. If you find it 2 years later, guess what? Because of the relationship between beginning and ending inventory and cost of goods sold, at that point, the error has actually self-corrected. Because what if beginning inventory was overstated, then yes, your cost of goods sold may now have been overstated in 1 year, but then it kind of, it rolls into the next year to fix the error. So I guess maybe you need to hope that you only find an error 2 years later. I don't know. I mean, that's probably not the right way to live your life. But if there was an error in 2020 and you only discover it in 2022, you don't have to make a correcting journal entry. You can rewrite or retrospectively adjust the 2021 financial statements, but all the numbers are actually going to be fine. They do, however, want you to disclose that there was an error. So I guess you can't completely hide away from the fact that you made an error, but this journal entry that you have to make over here in the if you discover the error in year 1, you don't have to make it in year 2. Okay, so that's the interesting well, I mean, I find it interesting, hopefully you do too, but that's the interesting part of how inventory flows through the company. And so I guess the easiest way that you can think about it is like if the error that happens in a particular year causes, let's say, net income to be overstated by, $20, in the following year, it will be understated by $20 because of the inventory numbers that were incorrect. So let's do example 6, and maybe if we go through the thinking around how inventory moves, this change will become even more obvious, like why this error corrects itself. So we'll do this, and then afterwards we'll take our break, and then we just need to do some ratios, and then we can go over the chapter 8 homework. So number 6 just says complete the following sentences. If ending inventory is overstated, excuse me. So obviously overstated means that the number is too high, right? Cost of goods sold will be what? Will it be too high or too low? And net income will be what? Too high or too low, right? That's the question. So what I'm going to do is give you like 30 seconds to just think about it for yourselves, what you think the answer is. If ending inventory is too high, is cost of goods sold going to be too high or too low? Is net income going to be too high or too low? And I'm going to
Laptop, please.
sorry, is someone talking to me or to someone else? Okay, no. So the hint here is, remember this relationship: beginning inventory plus purchases equals cost of goods available for sale minus the ending inventory equals cost of goods sold. So I'll give you a hint that this minus over here tells you that ending inventory and cost of goods sold always move in the opposite direction. So the higher the ending inventory, the lower the cost of goods sold. The lower the ending inventory, the higher the cost of goods sold, because of this negative, they're indirectly proportionate to each other. There's like a negative or an opposite relationship. So take another 15 seconds and think about, if ending inventory is overstated, meaning that it's too high, right? Is cost of goods sold going to be what? And net income is going to be what, and so on. While you do that, I'm just looking for something. Okay, so does anybody want to take a stab at this? That can be maybe, well, it can be anybody. If it can be someone who hasn't spoken before, that would be great. But okay, Gian, go ahead. You can go ahead, Gian.
Oh, yeah. If ending inventory is overstated,
Mhm.
cost of goods sold will be understated.
That's right.
Yeah. And net income will be overstated.
Right. Because cost of goods sold, sorry, what did I just do? Because cost of goods sold, right, Gian, is an expense. So so if the expense is under then the income is over, right? Because, so I'll just put your cost of goods sold is an expense. So the lower the expense, the higher the income. Hopefully that makes sense to everybody.
Suppose.
And what happens to, so I'm going to push it further because I realize I didn't ask this and I should ask this. What happens to retained earnings in this case?
In this case, I would say retained earnings would be overstated.
Yeah, yes, yes, because retained earnings is net income.
Yes.
Is net income kept, not distributed yet. Let's put it that way, not distributed yet. So because they're basically the same thing, they have to move in the same direction, right? So you're right, retained earnings is also overstated. So this is, I'm going to see afterwards how I can transfer this information onto the chapter 9 class workings thing, but it's a little bit easier for me to just write it out over here. So let's just review. Hopefully this is making sense. If you have ending inventory right over here and the number, there was an error in the ending inventory and the number got too high, it got higher than it was supposed to be, that will mean that the cost of goods sold is too low. Because cost of goods sold is an expense that is going to be, remember, sales less cost of goods sold is gross profit. So the cost of goods sold is a subtraction in the calculation to get to net income. If the cost of goods sold is too high, it will, sorry, if the cost of goods sold, see, I'm confusing myself. If the cost of goods sold is too low, the net income becomes too high, and net income gets closed off to retained earnings, right? So retained earnings will also be too high. So you see that an error in inventory is probably like, I mean, if you make an error in inventory, it's probably like one of the worst errors that you could make, because you kind of have to like run through, you know, the gamut, especially in ending inventory. The balance sheet has to be fixed. The income statement, you know, has to be revised. Retained earnings needs a prior period adjustment. It's a lot of stuff. It's very different to making, you know, let's say it's, well, I mean, I guess each transaction has to have at least two accounts. I was going to say if you make an error in revenue or something, but then there's also implications there. But it's a pretty involved thinking. And if you want to be really crazy over here, which I know you don't want to be, but I'll just add it. If you have net income too high, then your tax, right? Then taxes would have also been too high, because the more money you have, right? More money, more problems, as the classic hit goes. The more money you have, the more tax you have to pay. So taxes will also be overstated, because you would have based your tax amount on a net income number that is higher than what it should be. Any questions on that one? All right, so why don't we just do, let's just finish this out and then we'll take a break, because otherwise it's a little bit, you know, much to go back and forth. This should be quick. Let me give you guys another 30 seconds. Now you're going in the opposite direction, right? If ending inventory is understated, so it means that the ending inventory was too low, right? Too low. Think about what happens to cost of goods sold, what happens to net income, and I'll have someone else tell us your answer in about a minute. All right, who wants to tell us the answer here? Antora, go ahead.
If ending inventory is understated, cost of goods sold will be overstated. And
Yes.
retained earnings will be understated.
Yeah, so net income will be understated and, right, and we don't have this in there, but retained earnings will be understated as well because retained earnings is net income. And what will happen to our taxes, Antora?
Um, taxes, taxes will be understated.
Yeah. You don't sound like you believe yourself, but you're right. Remember the tax and the income are going to move in the same direction. The higher the income, the higher the tax, right? The lower the income, the lower the tax. So you're right, it's understated. So here we're moving now in the opposite direction, right? The ending inventory was now too low. So now cost of goods sold is too high. Remember, there's this minus sign over here. So they move in the opposite direction. Ending inventory too low, cost of goods sold too high, cost of goods sold is an expense. So when the expense is higher than it should be, the income is lower than it should be. Retained earnings is net income that has, been accumulated over time. So if net income is understated, retained earnings will also be understated, and taxes will also be understated. So when you hit the next year and you're trying to fix all this stuff, right? When I'm in 2022 and I discover the mistake that I made in 2021, I have to be a good accountant, right? And a good auditor and actually think of every line item that might be impacted by this error so that I can make sure that I make the adjustments. Of course, there's a journal entry, right? It would be debit, inventory, credit, retained earnings, but there's also still such a thing as deferred tax and a few other things that have to be fixed. So let's just talk about beginning inventory. So remember, beginning inventory is over here in this hint. Notice that beginning inventory and cost of goods sold, there's no minus sign here like there was with ending inventory. So beginning inventory and cost of goods sold are going to move in the same direction. The higher the beginning inventory, the higher the cost of goods sold, right? The lower the beginning inventory, the lower the cost of goods sold. So they are going the same way. So if beginning inventory is overstated, so it's too high, right? Then cost of goods sold, this is what I'm trying to say. I'll do this one and then you guys can do the second one on your own. Then cost of goods sold will be under. Sorry, what am I doing? Over. Sorry. Thank you to whoever just saved me from myself. Overstated. And net income will be, Gion, are you telling me what will net income be?
Understated.
And thank you. And retained earnings, I'm going to cut corners here a little bit. Retained earnings will also be understated because it's the same direction as net income. And our taxes will be what?
The same way, understated.
So notice that we've got over, and then everything, right, is under after that. So beginning inventory overstated. You really just need to remember that cost of goods sold and beginning inventory are going to move in the same direction. And then everything else should flow from the cost of goods sold is an expense. The expense is too high. So your net income and everything that follows from there will be too low because the expense is, again, opposite direction to the income. So you guys take 30 seconds for the last one. We'll get someone to call it out for us. And then after that, we'll go on a quick break. Okay, Jaren, I see you're ready for action, so go ahead.
So if beginning inventory is understated, COGS will be overstated.
No. Remember, they go the same direction.
So it's understated.
Yeah, because think about what's happening. Sorry, can you mute yourself while I talk? And then you can unmute. Okay, so Beginning inventory is the inventory that's already there, ready to be sold, right? So the beginning inventory plus all the purchases minus the ending inventory equals cost of goods sold. If the beginning inventory is made lower than it's supposed to be, then it means that you have even less stuff available to be sold, right, than you should have, which means your cost of goods sold automatically has to be lower than it could have been if you hadn't made that error. Okay, so because you made the error, your beginning inventory is too low. And because of the error, your beginning inventory being too low, your cost of goods sold will always have to be too low. Okay, they go in the same direction. With the ending inventory, it's different because ending inventory, the higher the ending inventory, the lower the cost of goods sold. So Jaron, do you want to finish this out? Cost of goods sold will be understated. What happens to net income?
So it's opposite,
Mm-hmm.
overstate.
Yeah. So retained earnings is also overstated because it moves the same direction as net income and this taxes business, right? Taxes will also be too high. So we have to fix that as well. And we fix it through something called deferred tax. So why do we care, right? You should be saying, so what, who cares? Because you have to make, unless you find the error in the second year. Remember, I told you if you find the error in the second year, and you can also see it in the book, if you discover the error in the second year, you don't have to make any adjusting journal entry. But if you find the error in the following year, there's always this journal entry that has to be made that either debits or credits retained earnings and inventory. So when you've thought through what the adjustment is, right? Then if you know that, for instance, with this last one, if beginning inventory was too low, cost of goods sold was understated, etc., then you have to go and say, do I have to debit or credit, right? Inventory and retained earnings. In this case, your inventory beginning inventory was too low. Your retained earnings ended up being overstated. So because the beginning inventory is too low, there's further impacts that I won't go into all of it, but basically retained earnings overstated means it was too high. So you're going to debit retained earnings and your inventory, you'll credit. And the reason you credit inventory is because when beginning inventory was too low, ending inventory ended up being too high. Okay, so I'll leave it at that. It's 11:45. 11:55 is when we start again. And when we start, we'll go over the ratios related to inventory. Okay. I'll leave this here for like 30 seconds in case anybody wants to ask me a question or you're still taking this down. And then after that, I'll stop the share. So you're on break until 11:55. Sorry, this thing always comes up. All right, so we're back from break. It's 11:55. I just before I move on to the analysis piece, I just wanted to highlight. I'm not sure I spent much time on this illustration 919. I was explaining it to you as we answered that question. But if you just wanted a quick reference again as to why the relationships are, what they are. Yeah, this visualizing the effect of inventory errors on page, I guess it's 483 of the book. Well, you all have the ebook, so just look at illustration 919. Remember, this is the relationship beginning inventory plus the purchases less the ending inventory, gives you cost of goods sold. Cost of goods sold is your expense, so that is included in the calculation of net income. So any problem here with ending inventory, opposite impact on cost of goods sold because of the less. Any issue with beginning inventory, it's going to be the same impact on cost of goods sold because they move in the same way. Once the cost of goods sold number is basically wrong, well, not wrong in quotes, actually wrong because of either beginning inventory or ending inventory being over or understated, that number flows into your income statement. So that income statement has a net income that's either over or understated. And then when you look at how to calculate your retained earnings, your beginning retained earnings plus your net income minus any dividend is ending retained earnings. This plus net income, if net income is over or understated, retained earnings will also be over or understated. And then just to be clear over here about the, the error correcting itself after 2 years. That's if it's an error in ending inventory, which is the whole scenario that's given in this question. Okay, so that's inventory errors. Does anybody have anything that, let me just say one more thing. I did copy, I mean, for better or worse, it doesn't look great, but I did copy the answer for example 6 into this class example workings Google Doc, so that whoever's using this document will just have a complete solution. All right. Does anybody have any other questions around inventory errors or any points of clarification that you need before, before we move into just talking about inventory turnover and days in inventory? Anything that doesn't sit well with you or that you need me to revisit? Okay, so I would highly recommend just reviewing the relationships a number of times so that you don't get confused about what is, what is moving in what direction, because it can get a little bit confusing. I think thinking about how you do the income statement, right? Sales less cost of goods sold will help you to figure out what happens to net income. Net income and retained earnings always going in the same direction. I think that thinking about this minus sign over here helps us to remember that cost of goods sold and ending inventory move in opposite directions. All right. And the book does discuss it, but I mean, the book discusses, in a narrative form, which can sometimes be a little bit difficult to follow because you're reading all these under and over and it can get a little bit wild when you're reading in the book. But if you try to keep this this formula front and center, and remember this formula applies to so many other things we've done as well. I think if you use the formula to drive your thinking around the relationship between beginning and ending inventory and cost of goods sold, you probably have a shortcut to remembering how to solve a problem like this. All right. So since no one is seemingly having issues, I'll just talk about presentation and analysis. And this is one of the things that we normally kind of skip over sometimes in accounting classes, where it's like, the disclosure, the footnotes of the financials, kind of like, well, as long as we can do the journal entries and stuff, do we really care about what, is going on in the footnotes. The footnotes are important. When you're working at companies and you're the one creating the footnotes or you are the one auditing the footnotes, you always have to make sure that you are actually disclosing everything that is required by generally accepted accounting principles. You also have to make sure that the numbers that are disclosed in the footnotes actually correspond to what is being shown on the face of the balance sheet and the face of the income statement. And then there's also all these extra, and remember, inventory is normally a big balance. So, you can't kind of mess around with getting the footnotes wrong either, because it's a big balance. You have to talk about which cost flow assumption you're using, to talk about whether you're using low of cost or market or low of cost net realizable value. If you have a change in inventory method, you saw that footnote, how you have to descriptively say why you're doing that and what's the changes and so on. If there's, God forbid, if there's an error, then you have to also disclose that there was an error and the changes that you made. So there's a lot of stuff around inventory. And then there are other things that we haven't even mentioned yet in our time together, composition of inventory. So sometimes people will show, which categories of items are in inventory. Is there financing around inventory? Like, are we using inventory as collateral for some type of financing? Is inventory or some of the transactions with related parties? Related parties mean some other company, organization, vendor that is somehow connected to us. So it's not necessarily maybe what we call an arm's length transaction. So if you have a family member and they have, let's say you are, you're selling baked goods and cake, right? Let's talk about cake. Let's make ourselves hungry. So you're selling cake and you have a family member who actually is a supplier of flour, and that flour is what you use to bake your cakes. That's a related party transaction. And if you were a really big company, if you were Entenmann's or whatever, you would have to disclose that your flour is coming from a related party, because the users want to know, are they charging you appropriate prices? Are you paying too much or too little, etc.? What inventory costing methods? I said that already. FIFO, LIFO, average cost. Have we been applying them consistently, or did we actually change from one method to another? Were there any LIFO liquidations? Remember, we spoke about dollar value LIFO, where we're trying not to have our LIFO layers liquidate, but sometimes, especially in times of COVID, you can imagine with all the supply chain crunches and all the issues that are going on with stuff being stuck on ships. And remember, in the summer, there was a whole thing with a ship that got stuck in the Suez Canal and people aren't getting all their inventory. You could actually have involuntary liquidation of LIFO layers, and that has to be disclosed, because that means that your cost of goods sold number is potentially lower than what it really should be, because now you're assuming that you're selling older layers of inventory because you're not able to buy new layers of inventory because there is such a problem with the supply chain. So it's actually something, if we were working for KPMG or Deloitte, PwC or Ernst & Young or BDO, some of these big accounting firms, if I was going in, like, let's stick with Whole Foods, if that was my client, sorry, not my customer, if that was my client, or if Home Depot maybe was my client, or General Motors, I should be going into the audit thinking, if you think about the risks this time, about what kinds of risks is the company facing. If they are on the LIFO method, a risk could be an involuntary LIFO liquidation, because they are not able to buy inventory fast enough to make sure that the early inventory at the lowest prices is not being assumed as being sold. So that, and then pledging inventories as collateral. Where does all this information get told to you to around what you have to disclose? It's all being said in the accounting standards codification. Remember the codification that we looked at when I was showing you what you needed to look at for the homework. Hopefully we'll be able to go through all the homework questions, and I can take you back into the codification and show you, we don't have to go through all of it, but I'll show you where in the codification they actually talk about presentation. And then the analysis, two classic ratios that use for inventory turnover and the days in inventory, or yeah, they call it average days to sell inventory. Inventory turnover, cost of goods sold divided by average inventory, trying to see how many times are you selling out your inventory over the period. So you can almost imagine that there's a warehouse that exists, and in that warehouse is the average amount of inventory that we carry. And you're asking how many times during the year or during the period does that warehouse empty and get refilled. So if you calculate an inventory turnover and the answer is, let's say 5, then it means that 5 times you are selling out that warehouse. That's a way of visualizing, because inventory turnover, the answer sometimes seems weird. It's like 5 times. Okay, what does that mean? It's just that I sold 5 warehouses worth of average inventory for the year. You want that number to be as high as possible. All right, because the more inventory you sell, the more revenue you are generating. And then the average days to sell inventory is a bit easier to understand, because it's, okay, so it's 365 divided by the previous inventory turnover that you just calculated. But why it's easier to understand is you're expressing how many days is the inventory sitting on the shelf, right? So how long does it take you to sell something? And so that helps you to see how inventory is moving. So obviously, if it's a perishable good, you would want to see that it's moving much faster than, let's say, a canned good. I mean, you want everything to move fast, but you don't want, a bag of salad to be having average days in inventory of like 30 days. It's too long. Obviously, companies can choose to do these ratios based on the entire inventory or categories of inventory. It depends on the nature of their business. We'll do an example which kind of just lumps all the inventory together for Walmart. It's example 5. I think the example is more about actually just making sure that we know how to do the calculation and what it means, as opposed to being that Walmart would necessarily just do one calculation for all its inventory. I think when it comes to inventory management, companies like Walmart are probably going to be trying to make sure that they are doing the stuff by category so that they can get good information on how to manage the inventory better. Before I move on, does anybody have questions about any of this before we do the example?
I'm good.
You're good? Okay. Sorry, I just realized that I have an administrative issue. I just need to send a message for like 30 seconds. Okay, thanks. So let me go to the question and we will do it together. Example 5. So this is coming from Walmart's financials from like 10 years, 11 years ago. So I'm sure their numbers are even bigger now, especially with the pandemic. A lot of people moved away from going to restaurants and stuff, and lots more people were cooking at home. So it would be interesting, not just inflation, but just to see how their numbers went up over time or over the pandemic. In its 2010 annual report, Walmart reported inventory of 33,160 million. So 33,160 million, that's actually 33 billion. Okay, so again, yeah, we see like these massive dollar amounts. That's what I mean when we're saying, we got to be very careful with inventory. If there's a material error or if there's some type of fraud in this thing, it can be big bucks, right, that we're talking about. So they have a 33 billion, and when all these numbers are in millions, right, and you're going to do the calculation, you don't have to add the 6 zeros on your calculator because everything is being expressed in millions. So you can just use, these 5 numbers as the basis for the calculation. The answer is still going to come out to the same thing. So 33 billion inventory on January the 31st, 2010. And okay, so they reported that, and 34.5 billion on January the 31st, 2009. So that's their ending inventory. This is seems like a weird date, but it's not really. The year end is January the 31st, which kind of makes sense because that's probably a slower time for the company. It's after the holidays and everything. So they probably also have a lower amount of inventory that they have to count and so on. And they can include all the sales from the holiday period in their revenue number. So this is the year end or ending inventory for those 2 years. But remember, ending inventory at the end of 2009 is beginning inventory, right? At 2010. Cost of sales is 304,657 million. So that's 304 billion for fiscal year 2010. And net sales, right? Their sales number is 405 billion. So you can see how much money this company is generating. Compute Walmart's inventory turnover and the average days to sell inventory for fiscal year 2010. So we got to be careful here because I don't remember seeing net sales in any of these formulas. It looks like we were given more information than we needed, and that is in fact the case. So that's pretty normal, you know how it is with these questions. They give you stuff and some of the stuff you don't even need. So you just have to remember your formula is just cost of goods sold divided by average inventory for inventory turnover. So this is going to be example 5. So the first thing is inventory turnover. Right, so it's going to be cost of goods sold divided by your average inventory. So average inventory is defined. So average inventory, sorry, I'm trying to type faster than my brain is faster than my fingers. So average inventory is going to be the beginning inventory plus the ending inventory. Right, those two, and you divide it by 2. All right, and that's partly just done because we're trying to make sure that there's no issue where maybe the beginning or let's say the ending inventory is so much bigger in 1 year or something, like there's some type of lopsidedness to the inventory. We're trying to just average it out to say, like, on average for the year, this is what we had, you know, in inventory. So that's why we take the average and not just, you know, the ending inventory number. In the case of Walmart, frankly, the numbers aren't that different. So, you know, it might be that it doesn't make that much of a difference, but we are called to do the calculation this way. So we were given a cost of goods sold number, or they call it cost of sales, but it's the same thing. So the cost of sales or cost of goods sold number is 304,657. So that's what I'm going to put as the numerator, right? And then I'm going to go do this average here quickly. So it's going to be 33,160, right, plus 34,511 divided by 2. And let me check so I don't have to retype everything again. So that should come out to, if you're also doing the math with me, 33,835.50. Okay, so that's the average inventory number. So the bottom is going to be 33,835.5. I'm keeping 2 decimals. I didn't have decimals on the numerator, it's just 00. Okay, and so yeah, this divided by this gives me 9. And so I'll, you know, again, go down to 2 decimals. It's on the dot 9 times. So remember what I said before about the average. It's Walmart sells its average, or sells, let me see, let me think about how to best say this. Sells its, its average inventory balance 9 times per year. It's probably the simplest, the most succinct way to say it. It sells out its average inventory balance 9 times per year. Okay, again, this inventory turnover should be familiar from the your prior accounting classes, specifically accounting 2, maybe other places that you saw it. Okay. Anybody have questions or need me to say anything more on this? Yes, go ahead, Gian.
Professor, I was wondering why the amount of $34,511 is the ending inventory.
Oh,
Is it-
maybe I swapped the numbers around. Hang on. Let me see. Maybe I messed this up. Yeah, I just, sorry, I swapped it around by accident. Thank you for asking. It should just be the other way around. So I'll just do this plus 33. That was not, that's the beginning. I just, yeah, I think I just copied wrong. Mhm.
So, I mean, it's a January 31st, 2010, and January 31st, 2009.
Mhm.
But I thought at the end of the beginning, at the end of the period is like a December.
No, it doesn't have to be. Remember, companies can choose any year end. It can be a calendar year, so December 31, or it can be what they call a fiscal year, which is any date.
Oh yeah, I see.
Any date. So
Oh.
that means this company's year starts on February the 1st and ends on January the 31st.
Oh, I thought it was January 1st.
No, it's fine. Yeah, yeah. So you thought maybe there was an error in the question or some type of confusion. Thank you for asking. But yeah, and that's what I was talking about earlier when I said, isn't this a weird date, January the 31st, right? That their year is ending. But a lot of retailers choose the end of January or sometimes February, like weird dates in February as their year end, because that's after all the busy time of the holidays. And it's also often a time of year when the inventory is at its lowest point. So there's less work to count the inventory. So they often choose January and February as their year end.
I see.
Okay.
Thank you.
Okay, you're welcome. Anything else? All right, so that's inventory turnover. So now we're going to do days in inventory, which we know the formula, right, is 365 over inventory turnover. So you kind of always have to do the inventory turnover calculation if you want to figure out what's the days in inventory. So this is fairly obvious here. You're going to say 365 divided by 9, right? I'm just writing it out in case someone comes back and they're like, where did that number come from? And so that's going to be this. So it's 40.55 or 40.6. So that's approximately 41 days, because we don't really look at, like this part of a day is still going to be an extra day. So this just means that inventory sits on the shelf on average 41 days before it is sold. So if you think about Walmart, this is why I said that companies don't generally calculate these numbers for just the entire body of inventory. Because if you think about Walmart, like, hello, there's like milk and stuff that's on the shelf that's being sold within like a day or two of arriving on the shelf. So how can it be that that the inventory, is that the days in inventory is 41 days. But remember, Walmart sells all kinds of other things that could take forever to be sold. I mean, these companies have a vast array of inventory. It's not just food, there's clothing, there's appliances, there's all kinds of stuff. So if I was the inventory manager, this would be less meaningful for me, because it's just saying all the inventory on average, that's how it sits. What I would now go and do probably is try and split the inventory out into categories, maybe perishable food, non-perishable food, textiles, blah, 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 and then try and see in each category how long the stuff is on the shelf. And that will help me to make decisions about how to purchase, what's the popular items, how can I manage my inventory better to open up as much retail or shelf space as possible, and also make sure that the inventory keeps moving. All right, so 41 days is the average, but again, that doesn't mean that every item that the store is selling is in fact sitting on the shelf for 41 days. That would be crazy. That's it for inventory turnover and days in inventory. Anything that anyone wants to add, because that's also the end of chapter 9, and I'm going to kind of whiz through to the chapter 8 homework and just look at, you know, any highlights that need to be reviewed. Anything else for chapter 9 that you guys want me to talk about or anything? All right. So you know where to find the calculations, you know where to find the recordings also for the lectures if for some reason you need to look at them again. Okay, so that's not it. Let me go back into McGraw Hill. Okay, I got thrown out. It's fine. Okay, so chapter 8 homework, you know that you obviously know that these homeworks are algorithmic, which means that, you know, my numbers are not your numbers. So, you know, if you want to take a moment and open up your questions and stuff, my numbers are not even the same. Like every time, the last time I opened up this question, you know, the answer was 260,000. Now the answer is 239,000. So, you know, it's changing all the time. I guess the whole point here is obviously that the numbers may not be the same, but the thinking around the stuff, around, you know, these answers and so on is the same. We'll see how far we get. If we don't finish going through every single question today, we can finish this up. I hope this is going to be helpful. I mean, I hope people aren't going to be bored, you know, out of their minds because they already finished all the work. I would consider this, if I were you, as a type of review, and you know, remember where this, on which day this was, so that when you maybe are studying for the test, you can come back and look at what I was saying. So the first question here was basically also like the first question we ever did in class around goods in transit, right? And, you know, we did goods in transit and consignment goods. So it's saying that the company's inventory balance at December 31 was 190,000 based on a physical count, right? Before they considered any of the following transactions, which means that you now have to decide whether any of these things need to be added onto, excuse me, the inventory balance to come up with the correct amount. Okay, so your starting point is 190,000, and the book kind of shows, you know, that this 190,000 is where we start, and then you're not going to look for things to subtract. Why? Because it says before they even considered the stuff. So it's almost like in the class example that we had where it said that things were excluded. If something was already excluded, you don't need to subtract it again from the answer that you had. So it says that this is Quack is the company. So goods shipped to Quack FOB destination. We know that it's if it's FOB destination, you are well, let me first just talk about FOB destination in general, that the seller owns the goods until it reaches the destination. And so you have to ask yourself, am I the buyer or the seller? Then you have to ask, what are the shipping terms? And then you ask, are you going to include or exclude these items? So they were shipped to Quack FOB destination. So since it's shipped to Quack, we're the buyer. FOB destination, the seller owns it, right? While it's in transit. So they were only received on January the 4th, which means it's after the year end of December 31st. So that means that we never owned the stuff while it was traveling. Even though there's 35,000 attached to it, we are not going to add it onto our balance. So number one, you do nothing, okay? Because you're the buyer, the stuff belongs to the seller until it reaches a destination. It reached you after December 31st, so you shouldn't include it in your balance for December 31st. All right. Number two, again, shipped to Quack, but now it's FOB shipping point. FOB shipping point, the buyer owns the items while they are in transit. So that means that Quack owns the items in transit. They were shipped on December 28th. They were only received after the year end, but it doesn't matter because December 28th is before the year end. And since it's FOB shipping point, it already belongs to us on December the 28th. The invoice was 22,000. So that means that that 22,000 should have been included in our inventory balance. Okay, so notice how the entire process is revolving around, you know, is it FOB shipping point or destination, and are we the buyer or are we the seller? all right? Goods shipped from Kwak, so Kwak is the seller, to a customer FOB destination. So when it's FOB destination, the seller owns the items. That doesn't change, right? FOB destination, the seller owns the items until they reach the destination. FOB shipping point, the buyer owns the items while they are in transit. So they shipped from Kwak, who is the seller, to a customer FOB destination, so the seller owns it, on December the 27th, were only received after year end on January the 3rd. So that means on December the 31st, they're still in transit. And since Kwak is the seller, Kwak owns this inventory on December 31. Remember, the whole question is on December 31st, does this stuff belong to you? Now they're trying to confuse you by telling you that there's a sales price of 45,000 and a cost of 27,000. It's obviously the 27,000 that we're looking at. We don't have to worry about selling price when we're calculating inventory for the sake of this question. So you add on the 27,000 because it actually belongs to them and they had not yet included it in their calculations. And then goods shipped from Kwak. So Kwak is the seller to the customer, FOB destination. So Kwak owns the goods while they are in transit. They were shipped on December 26th, but they were received before Kwak's year end. By December 30th, they reached the destination. So that means that they now belong to the customer, all right? On December 31, they've already been received, so it belongs to the customer. So even though it's an FOB destination, it doesn't matter because the date over here of receipt by the customer is before the year end. So we do not add the cost of this merchandise onto our inventory balance. It doesn't belong to us anymore. This one was, you know, I guess somewhat tricky because they, you know, doesn't have this January date where the stuff is being received. It's actually being received in December. So you have to know that you're doing the inventory count on December 31st. So since this was already received on December the 30th and it's FOB destination, it belongs to the customer at December 30th and no longer belongs to Kwak. Goods shipped from Kwak, so that's the seller, to a customer, FOB shipping point. So FOB shipping point, the customer owns the goods as soon as they are loaded onto, you know, the van or whatever, as soon as they are at the shipping point. So by December 28th, this already doesn't belong to Kwak, right? Even though it's only received by the customer on January the 4th, it doesn't matter because shipping point means that it belongs to the customer while it's in transit. So this merchandise cost of 17,000, we do not need to add on. So in the end, it was really only number 2. Even though our numbers are different, you would have the same, you know, items. It would have been number 2 that you needed to add on, and number 3 that you needed to add on to the 190,000. So that's a 239,000 balance. For my question, you have your own balance. So, you know, this company would have had to make a $49,000 adjustment to the inventory. Any questions on that? I know most people got this right already, but I'm just hoping that talking through the process might help. Oh, okay. Okay, so the next one is just saying is you know, did the company account for these transactions correctly or not? Right, that's the thinking over there. So I'll speed through some of these things a little bit because I know that people were kind of okay with them, having looked at your results, but I'll go quickly. The following inventory transactions took place near December 31, so the end of the year, right? And select whether Rasul correctly accounted for each of the above transactions. On December the 27th, 2021, merchandise costing 2,000 was shipped to another company on consignment. The shipment arrived at Maya's location on December the 29th, but none of the merchandise was sold at the end of the year. The merchandise was not included in Rasul's ending inventory. This is incorrect because when Rasul is sending merchandise on consignment, that consignment merchandise belongs to Rasul until it is sold to a customer. So the fact that it was not sold by the end of the year means that it still belongs to Rasul. So the transaction is not correctly accounted for. Okay, they should have included it. Oh dear. This thing. On January the 5th, 2022, merchandise costing 8,000 was received from a supplier and recorded as a purchase on that date and not included in the 2021 ending inventory. So this is really close to the end of the year. So you have to be careful about the shipping terms, okay? The invoice revealed that the shipment was made FOB shipping point on December 28th, 2021. So if it's FOB shipping point, that means that the buyer owns the goods while it's in transit, and it's in transit already on December 28th. And Rasul purchased this inventory, so they are the buyer, right? So this should have been included in the 2021 ending inventory, but they didn't include it, so it's not correctly accounted for. You can see how easy it is to make errors with shipping terms, and or also to commit fraud, frankly, with shipping terms close to the end of the year, right? Because you're saying we're already in 2022, we received this 8,000 of inventory, we think that it belongs to 2022, so we're trying to record it for that, but then we go look at the invoice and we see that it was actually FOB shipping point before year end, so it did in fact belong to us, so we made a mistake. On December the 29th, 2021, so close to the year end, the company shipped merchandise costing $12,000 to a customer FOB destination. FOB destination means that the seller owns the merchandise or inventory while it is in transit, okay? So that means that we have to see when the inventory reached the customer. The goods which arrived at the customer's location on January the 4th were not included in Rasul's 2021 ending inventory. The sale was recorded in 2021. This is incorrect. Okay, they should have included it in the ending inventory because the customer only takes ownership of the inventory after December 31. So while this inventory is still in transit, FOB destination, the company or the seller, being Rasul, is the owner, but they did not include it in the inventory. They should have. So this is wrong, right? Not correctly accounted for. Number 4, merchandise costing 4,000 was received on December 28th on consignment from another company. A purchase was not recorded and the merchandise was not included in Rasul's ending inventory. That's correct, because when you receive merchandise on consignment, it doesn't belong to you. You shouldn't include it in your inventory, and it's definitely not a purchase. It's just consignment. So in number 1, we sent stuff. Rasul sent stuff on consignment and it does still belong to them. In number 4, Rasul is receiving stuff on consignment which does not belong to them. It belongs to a born company. And then the last one, merchandise costing 6,000 was received and recorded as a purchase on January the 8th, 2022. The invoice revealed that the merchandise was shipped from the supplier before year end, right? December 28th, 2021, FOB destination. FOB destination means that the goods in transit belong to the seller. We are not the seller, we're the buyer. So it belonged to the seller until January the 8th, 2022. So we did not need to include it in our 2021 ending inventory. So we correctly accounted for that. So how do you answer these questions, right? Because it feels like it gets really hairy, it gets a little bit crazy. You have to ask yourself a few questions. When you read the scenario, you have to ask, am I the buyer or the seller? Right? So you answer that question. Then you have to ask, what are the shipping terms, right? Is it FOB destination or FOB shipping point? So you figure that out. Then once you know that it's FOB shipping point or FOB destination, you ask, who owns the goods in transit? So that the shipping terms will tell you who owns the goods in transit. Then you have to say, do I need to include, so based on all of this, do I need to include this in my inventory or exclude, right? That's the next step. And the last question you ask is, what did I do? So did I already include it or did I exclude it? Or, you know, because sometimes you make a mistake and then you have to fix it. So am I the buyer or the seller? What are the shipping terms, right? Based on the shipping terms, who owns the stuff, right? Did I or should I include or exclude this based on the shipping terms? And then did I already include or exclude this, or do I need to make some type of adjustment? So it's kind of like the reason it sometimes feels a little bit crazy, these questions, is because it's one sentence, but it's like a 5-point process of trying to figure out whether you actually own the goods or not. And when it comes to consignment, remember, if you are sending goods on consignment, they belong to you until they are sold to a customer. So you include it in your ending inventory. If you are receiving goods on consignment, they don't belong to you. They will never belong to you. So you do not include it in your ending inventory. Okay, it doesn't, there's no circumstance under which you will include consignment inventory that you received in your own ending inventory. It absolutely needs to be kept separate from your stuff because it belongs to the company that sent the consignment goods to you. Right, so hopefully that provides some additional clarity, maybe plans of action on how to answer these questions, and not, you know, again, it's so deceptive. It's like 1 or 2 sentences, but there's like five thinking steps that you have to do to actually get to the right answer. Anybody have anything that they want to add or subtract from what I'm saying? You know, it's fine to ask questions. I'm not trying to you know, buzz through this so fast without anybody saying anything. It's more that I know that a lot of people already did these questions and they got them right. So I don't want to bore you to tears by going through them, you know, so deep. But my hope is that just by reviewing them, something might come out where that helps you to think more clearly about the, you know, how to answer the questions when you're actually faced with this in a test. Right, because homework is one thing. You've got all these multiple, you know, attempts, and you can just go wild. You can get hints. You can look at the textbook, but you got to be a little bit faster when you're doing this for a test. All right. So, yeah, in this question, I mean, you've got your typical FIFO, LIFO average cost. You know, inventory and cost of goods sold calculations. I don't really need to go through every single item. That will, you know, be super tedious. But what I will say is, you know, this is a typical structure of the question. Be careful here, you know, because you've got purchases and sales all mixed up together. You have, or you were given this format which helps to show you, you know, what's the cost of goods, the total cost of goods available for sale. So you have to go through and you say, okay, I start with my beginning inventory, then anything that was purchased, I have to populate, right, with the correct prices. Please pay attention to detail. And then you have eventually this 195,750 is the total cost of goods available for sale in general. And then the 31,000 is the total units that are available for sale. Notice what the question says. I think, you know, we spoke about this in an earlier class about how many decimals. I think Antora was asking me when we're doing retail inventory method. It's telling you here in red to keep 2 decimal places. All right, so please do that. You don't want to find out that you're getting answers, you know, partially incorrect or whatever because of a decimal issue. That's very frustrating. So it's a periodic inventory system, which means that, you know, you're kind of at the end of the year and you're just doing all these calculations. You don't have to worry about moving averages or, you know, like with the perpetual, which is the next question, the perpetual method, you kind of, especially with LIFO, you have to watch out to see what was the latest layer of purchases to make sure that you aren't messing up your calculations for cost of goods sold. So what does it say? You have, right, the 31,000 total, then you have to kind of add up how many units were sold by going through, right, there's 2 things here for what was sold. So it's 22,200 units that were sold. So 8,800 units were left in ending inventory. That's just a calculation that you can do. well, the 88 is there, so you can also just subtract it from the 31,000. However you want to figure that out is fine. But the the most important part of this is to remember that for FIFO, right, the first thing in is the first thing out. So as you work through your cost of goods sold, you're always assuming that the earliest units were sold first. That's why you start with, the inventory that was on hand and move your way through the, I guess that you can call it the remaining items that were purchased, but working from the earliest dates, right on. And then the ending inventory again is going to be, because it's FIFO, it's going to be the latest units because those are still remaining to be sold, and they're going to be at whatever price, right, that they were purchased. I think the mechanics here a little bit I don't want to say unusual, but I mean, you kind of do, because we're in an online system, you can't just write however you want to write this. It does want you to kind of fill this into like exactly how they want it to be filled in. So, under normal circumstances, we may have gone by dates and said, okay, we do, what was sold on the 14th and we write it all out. But what they're assuming here is that you're basically just adding up 22,200 units of the earliest units and you're pricing it out, and then you're just pricing out the 8,800 of the latest units. So you do need to remember that that rule, right? That for FIFO, it's the earliest units that were sold, it's the latest units that remain behind in ending inventory. These two numbers together in yellow have to add back up to the 195,750, the 8,800 and the 22,200 have to add back up to the 31,000. If we look at LIFO, you've got the same setup here, but you now have to remember that with LIFO, it's going to be the latest units that are sold first. The last in is the first out. So they start building from 4,900, the latest unit, and they go up to 2,200, right? So they take the 4,900, they take the 8,700, and then you have to split this batch. 8,600 is sold, 5,900 remains. And then the beginning inventory, is still assumed to be on hand. And so that's how you price out your 8,800 units. So again, the cost of goods sold, which you can immediately see is much higher under LIFO than FIFO, plus the ending inventory gets you back to exactly the same number, 195,750, and then the 31,000 units you can also add back. Then I'll just finish this one and the rest we can talk about on Monday. Cost of goods available for sale, same deal, right? This setup on the table, but then what you're saying is for cost of, first of all, you got to get the average cost per unit. So you're going to take the total cost divided by the total units, and you're going to get $6.31 plus or minus a penny. 22,200 units sold multiplied by the $6.31 gives you a cost of goods sold of about 140,000. I know your numbers are different, but the mechanics are going to be the same. And then you take the number of units in ending inventory multiplied by the average cost of units to get your ending inventory. Again, these two numbers have to add back to 195. So that's the periodic LIFO, FIFO, I'm completely messing this up. LIFO, FIFO average cost. Let me see if I can actually get back to my stuff. Okay, and next time on Monday, I'll start by going over questions 4 through 8. I especially want to spend a little bit of time on 8 because that was the one where you had to go into the accounting standards codification. I want to make sure that people don't have questions on that. And if since you know that I'm going to be spending some more time on the homework, there's also the $2 value LIFO questions. If you think of questions that you have for this homework over the course of the next few days, just jot them down so that you can ask me when we're back together. Well, we're not together on Monday because it's a public holiday, right? Is this coming Monday? Am I going crazy? Or is it right? Yeah. No class. So I'll see you then on Wednesday. All right, so remember that there's no classes on the 11th because it's Indigenous Peoples Day or Italian Heritage Day. Any questions about the no class issue or anything that anybody wants to talk about?
When will be the homework? Chapter 9 will be available.
It's already available. It's been available since September the 10th. It's over here. So if you're in the student view, you remember if you bought I think was it who helped me with this? Was it Christopher or someone? If you bought the $90 version or whatever of Access, then there's some like weird thing that says like no homework due in the next 7 days or something, but you have to go to a drop down for our class to actually see the homework. Under the student view, your homework is there, chapter 9 homework, it's available. You can start.
Wait, can you please hold on a second before you leave? I just want to check.
Yeah,
I bought it last night.
I'm not leaving, don't worry. I will pause the recording. Everybody else is